Hi, this is Daniel, and you're watching Unrivaled Investing, a channel about no hype, just a simple mission, a mission to find you unrivaled companies and exceptional investments. And so today's video, we're going to be talking about XL Fleet, which is merging with Pivotal Investment Corp 2. The ticker for Pivotal Investment Corp 2, which is the current publicly traded vehicle, is PIC. The ticker for XL Fleet after the merger is completed, which is scheduled for the fourth quarter, will be XL. So what is Pivotal Investment Corp 2? What is XL Fleet? What's the business model with XL Fleet that's going to drive potential shareholder returns over time? Because at the end of the day, Pivotal Investment Corp, this is a SPAC that's merging with XL Fleet. So the question is, what's XL Fleet's business model? What's going to drive their financials in the future? What's the opportunity look like? Does this have 10x potential? Does it have a huge potential return over time? And do they have an unrivaled value proposition? I'll get to each of these key points in further detail, greater detail, when we hit them up. Lastly, I have a free investment calculator for you to play with if you get to the end of the video. But before digging in, if you enjoy learning about potential multi-baggers, the types of companies that can go up hundreds or even thousands of percent, make sure you're a subscriber. If you're already a subscriber, make sure you hit that thumbs up button. Greatly appreciate it. Also, if you want to know what I'm personally doing month to month, go to unrivaledinvesting.com. The reality is all it takes is finding one potential multi-bagger to change your life journey. So if you're interested in following my journey to find these potential multi-baggers, go to unrivaledinvesting.com. By the way, I love it when you post your comments at the end of this video saying, hey, learned a lot from this, but I'd love for you to look at this next company, because that's the reason why I'm making this video. This goes out to all the Journey subscribers that asked for it, and all the YouTube subscribers as well that are asking for XL Fleet. I'm making this for you. Let's dig in. So first, starting Pivotal Investment Corp, because that's the current trading vehicle. PIC is the ticker. It's a SPAC. A SPAC is a pile of cash. This holds over $200 million. We're in the middle of a SPAC craze. Part of the reason why is because interest rates are so low that people are looking for low risk, potentially high return, or at least single digit return investments. And the way SPACs work is that if you get a deal that a lot of people start frothing over, maybe you can make a lot of money. If at the end of the day you don't like the deal, you can always reject it, and you get back pretty much the cash that you invested. So in a low interest rate environment, SPACs are very attractive for a lot of potential investors. SPAC is a pile of cash looking for a deal. The pros, cons. Pros, it makes it easier for a company to get cash. The cons is that it's easier for crappy companies to become public. And so, I've actually done a bunch of SPACs videos already. IPOB, Clover, which is IPOC, Desktop Metal, Multiplan. So if you're interested in seeing some of those where I talk about SPACs in actually greater detail, you can go to that. I even did a whole video just on the current SPAC craze. We're in the middle of a SPAC craze where every day it's like a new one's coming out, which, by the way, I'm excited about. I like seeing all these new companies that are coming out. It's a sign of a promising future. So what are the terms of this transaction with Pivotal Investment Corp 2? And you look at, it's actually very simple terms. You have this 200 million cash from the SPAC, another 150 million, effectively friends of the founders of that SPAC saying, hey, we're willing to commit 150 million. And all of it is going to the balance sheet of the company, which is what I like to see. I like to see that, hey, the cash is going to the company. It's not going to paying out existing shareholders. That said, 8% is going to the bankers, because the bank has got to get paid in order for the machine to keep working. That's just how capitalism works. Like, you got to deal with it. 8% cut to the bankers in order to make this happen. Meh. The reality is I generally see these fees around 30, 40, $50 million. So I think the larger the SPAC, the lower the percentage fee. And so here it is, just because it's 200 million SPAC plus the pipe. That's the reason why it's a relatively higher percentage. That said, so what is XL Fleet? Because that's actually going to be driving the value in the future. So XL Fleet, which will be ticker XL, it's a company looking to develop the electrification needs of the time. And they're targeting commercial trucks. They already have 200 fleet customers out there with 3,200 units and 130 million miles driven. So this is a legitimate company. This is a real company with real products. This is not pie in the sky like, hey, we're going to sell this in the future with a, future product lineup. Like, they have current solutions with real customers deployed across thousands of vehicles, and they're rapidly expanding. So I like to see that there's actually some meat to the bone here. This is not just some theoretical company. And you can see that they're targeting any sort of commercial vehicle, whether or not it's a utility van to a semi-tractor. And you can see where their range of solutions currently are, where they have solutions for this class 2 through class 6, which is smaller vehicles to larger vehicles, like a school bus is a class, I think class 6. But then if you wanted like a semi-tractor, you're looking at class 7, class 8, where that's under future development, what they're looking at. So you can see this range, how they have the smaller market as well as mid-size existing applications. But what exactly do they do? Because I said, I sort of had a nebulous description, develop the electrification needs of the time. There's a hint of adapting to the market with saying that, and you're going to get that as a vibe throughout this whole presentation, which is that you have management that adapts to the marketplace, which is something I want to see. It's not the strong or the quickest that survive. It's those that are most quickly to it. Those that adapt the fastest are the ones that survive. And in capitalism, it's all about survival, baby. So let's, what exactly does XL Fleet do? And at this point, it's about creating hybrid vehicles. Looking at total electrification, a totally electric vehicle will potentially be in the future. But right now, their solution is about enabling current vehicles to become hybrids. And what's that mean? So you take an existing body of a vehicle where the original equipment manufacturer, think a Ford or a GM, they'll have the engine, the transmission, the fuel and exhaust, so everything sort of stays the same. But then all the orange dots reflect their value add with this motor drive, the traction motor, which has regenerative braking and electrical assist, and a battery pack. So there's a lot here. You need to sort of take a step back. Like, what does hybrid mean? What's it mean to when you make a vehicle hybrid? And just like, instead of like thinking about these individual components, it's about, instead of just running on an internal combustion engine where, hey, you put your gasoline or your diesel, in the car, you that's how you're powering the engine. You add an electric motor and maybe some additional things like a traction motor that helps turn the wheels. And so you use less gas. It's all about using less gas, lowering your operating costs for your commercial fleet. So it's not a perfect solution. It's not like, hey, you have a completely electric vehicle, but this is a start to a solution. This is not the revolution. This is a start. That it's also worth pointing out that they have this XL link. This company's been around actually since 2009. So they've been focused on this, learning about the marketplace, about solutions that customers could potentially want for several years now. They started with effectively this XL link, which allows fleet operators to monitor how their fleet is performing, how their individual units perform day to day. And so you get a sense of like, well, this is how it performs, this is how it accelerates, this is how it stops, what the drivers are doing, what's the wear and tear on these vehicles. So this is having that data insight. It's actually really important when you think about how you need to build a future vehicle. What's important? What do you need to optimize? That said, how do they install this in their vehicles? And what's interesting, and this is actually a key part of the business model, so you do need to pay attention to this. And this is part of adapting, and you can see I've spelled adapting very well over here. Adapting, where you start with the original equipment manufacturer, then they work with the upfitter. Now, the upfitter is the one that usually provides some sort of body that goes on top of the, that goes on top of this layer. And so this upfitter, so like, hey, this could be a school bus, this could be, a tow truck, it could be any of these types of bodies. You're working with the upfitters to get that made. And then, so where XL is fitting in is they're working with this upfitter to make sure their electrified powertrain or their hybrid solutions can get added to the vehicle. And so that's the key part. It's adapting to the modern manufacturing system where they partner with the upfitters, creating a lower cost, lower capital intensity business model because they're effectively working with folks that are already doing this type of installation. They don't have to build a factory that's assembling these cars themselves. They're saying, hey, you're already doing this. Let me work with you so that way you can help layer these pieces on to what Ford and GM and Isuzu is already doing. So that's a key point for you to think about, because when you are lower cost, lower capital intensity, it should mean in your mind that it's going to be easier to scale, and scale means growth. So if it's easier to scale, it means it takes less money for you to grow faster longer term. You grow faster, investors get excited, like, hey, what's your potential? Who's buying this vehicle? And you can see they have a pretty incredible customer base. You see some major fleets like DHL, you see major universities like Harvard, Coca-Cola, Pepsi, FedEx. I mean, that you see all these major utilities. This is really interesting. And then they also show that their largest annual orders. So the biggest elephant that comes through in any given year has been getting bigger each year. And that is great to see. Like, all these things are adding meat to the bone of understanding the thesis here. Like, wow, there's a lot here. You're selling real products to real customers. This gets me excited. Now, normally when I'm looking at some of these SPACs, especially the EV plays, I get nervous and I'm like, you know what, this is too theoretical for me. I'll size it up after I see some execution. This is starting to show that there's execution here and there's customer buy-in. You can't really fake real customer buy-in. You can fake product demos. You can't really fake sustainable customer buy-in, especially over several years. Maybe you can get some preliminary orders that that can mislead you as an investor. What I want to see is consistency, execution. And that's what I'm seeing by them saying their largest annual order has gone up an order of magnitude, where in 2020, it's 1,100 is their largest order versus just 200 in 2018. So there's real customer buy-in here. What are the economics for the customer? Because this is, if you're going to think about your growth, you need to also see it through the eyes of your potential customer. What are the economics for the customer? And this is part you're going to need to put on that thinking cap. I was looking if I had any thinking caps around, not today. You're going to need your thinking cap in order to do this, where they're saying you have fuel savings of 1.5 million. You have maintenance savings because it's less stop and go, wear and tear. You don't have to take it to the gas station as much. So maintenance savings of 200,000, driver productivity savings of nearly 200,000, because, hey, once again, the driver doesn't have to stop as often. Engine downside savings of 90,000. So all in, you add all this up, it's nearly $2 million. Then they say total savings net, because this nearly $2 million is gross. Then you have to look at it net, like what is the net cost of effectively going from standard engine to hybrid engine, because you have to think about that cost. And the reality is it goes from 2 million to 700,000 as your net savings over the lifetime. And so, based on that, they're saying it's around 56% return on investment. And you see the key component here is fuel savings. And you can see their assumptions below, where they're saying a 10-year service life, fuel cost of $3 per gallon, and $50 per hour driver salary. Like for example, thinking about that the driver productivity savings. So there's a bunch of assumptions here. Like, for example, this case study becomes much more valuable in the event that, like, let's say oil prices were to double. Then you could definitely make a case of like much more dramatic fuel savings and driver productivity. Like everything sort of gets better if you have higher fuel prices, if you're making the case for hybrids. So it's 56% return on investment. This is supposed to make you think this is great. This is the first level thinking, like 56% return on investment, thumbs up. That's why it's important. Like, whenever you see something like this, you actually really need to make sure that thinking cap is locked on, because you need to go beyond this first level thinking. You actually need to think a little deeper. And the reality is these numbers are kind of nebulous, where, the total cost, which is looking at the difference between the gross and the net, is around $1.3 million. And this, keep in mind, for a fleet of around 100 vehicles. You can see these types of vans. And so they're saying that the net savings is $673,000 versus a cost of 1.3 million. That doesn't actually equal the 56% return on investment. That's closer to 52. Nevertheless, let's actually start thinking about this second level thinking. And this is the part that makes me go a little bit. So for a fleet of, let's say, 100 Ford vans, and I get the price of the Ford vans by going to Ford.com, and here's the picture, and it shows that it's around $35,000 per van. So like I'm doing a ballpark here, how to think about it. For a fleet of around 100 Ford vans, a net savings of 700,000, and that's what they're saying. A savings of 700,000. That's what I got from the last slide. Gross savings around 2 million, and versus a total non-hybrid cost of 3.5 million. So you need to have an upfront investment of 1.3 million to go from the standard package, the non-hybrid solution, 3.5 million. You need to put in another 1.3 just to go hybrid. So that's a huge upfront investment. That's nearly 40% more of an upfront investment. And so all in closer to 5 million versus the 3.5 million if you weren't to get a hybrid. And then you potentially save 2 million over 10 years. And keep in mind, that's spread out over 10 years based primarily on your fuel savings. So it's actually a much, much tougher calculation, because keep in mind that delta of putting 1.3 million upfront to electrify your vehicle, like you need to think about that opportunity cost. Like, what's it cost you to borrow those funds? Or if you could be investing those funds in something else, if your opportunity cost is 5, 10%, 15%, then, that total cost of ownership, that it's much tougher to make that sort of calculation. What you can definitively say, once you've made that purchase, it's going to be cheaper to own. But when you think about the total dollars in, total dollars out over 10 years, it's sort of tougher to make that argument that, hey, the total cost of ownership is dramatically lower. No, the total cost of the cost of operating is going to be lower, but the total cost of ownership, not so clear about that. And so, when I see, going back, I see all these major brands, brands where it's important to have a good reputation. Now it's starting to make a little bit more sense why they have these major brands. And I'll dig into this in a little bit more detail, because it's driven somewhat by economics, but other elements as well. So economics is definitely a factor, like lower operational costs, but other elements as well, like a cleaner environment, which is great. I'm totally for green initiatives. Awesome. Sustainability, I'm absolutely for, and publicity. Like, we have to be honest about that. And, why can I say that with a straight face? Is in their own case study on Coca-Cola, they talk about over $20,000 per van in net operational savings. That's based on brake maintenance, engine downsize, fuel savings, driver productivity. But then they also call out, and this is they say they use 20% less fuel compared to Coca-Cola's conventionally fueled vans. That's great. Like, that's awesome that they're using less, unsustainable fuels. But they also call out media coverage, 26 unique pieces of coverage that reached 24 million readers in major publications such as USA Today, Green Fleet, and Fleet Owner. Like, I think it's good. Fine. Get the publicity. But the reality is, it is a calculated judgment that's beyond just economics. There's these other factors as well that are tilting the scale. You see the same thing with Pepsi. Here it is, Coca-Cola and Pepsi making peace on the same page, where they're calling out that it's a 20% reduction in fuel use, and the gross savings per van of $20,000. It's all based on this net operational savings, where you're looking at what's your fuel costs in any given year, versus your total cost of ownership. I went through all their case studies that that XL Fleet calls out, and none of them talk about how they're dramatically lowering the economic cost of owning these vans. So it's a bit of a, hey, we have this policy that we need to meet, and how are we going to do that? This is one of the ways we do it. And for example, in Pepsi, they say, plus the reduction in greenhouse gas emissions is helping PepsiCo achieve our corporate sustainability goals. I'm glad they have these sustainability goals. Like, I'm not trying to put this down, but what I am saying is that if you don't have the luxury of having a flush balance sheet and you need to think purely on an economic perspective, it may not be super clear to you that you should do this. If you're like, hey, I'm a small fleet owner and I'm not flush with billions in cash. I paying an extra 40% up front's a big deal. Then in that case, you might just stick with traditional internal combustion engine without any sort of hybrid benefit. So, I don't think you get the true electrification revolution until the total cost of ownership drops for electric vehicles well below internal combustion engines. So we're not at the point of revolution. We're at incremental improvement, incremental adaptation, which is still good. Don't get me wrong. Like, maybe there's still an opportunity for adapting to the marketplace. Let's see what I mean. So, here's sort of their timeline and what the market demands that they're addressing. And you can see, like, their first product, XL Link, it was all about optimizing fleet usage. And that's the unit that goes within each truck or each, vehicle that shows how the vehicle's being used. And then they showed the XL Hybrid. So it's working their way up, which is, the market demand is reduce operating costs. It doesn't say reduce total costs. It's 3 to 5 year return on investment. Up to 25 miles per gallon improvement, 25% mile per gallon improvement. Then next is the XL plugin, where they're talking about meet sustainability goals. These are the goals that, like, Pepsi or Coca-Cola are talking about. And then here's where it starts getting interesting. XL Electric, and they call that out, and that's something that's a future product. So you can't really bank on it as much because, you don't have the proof yet. But they're saying it's a cost effective zero emission vehicle. And so that's, when you say something like cost effective, then you're saying, well, maybe with some tax benefits, this will be as, on par with buying a normal internal combustion engine. So that's, you start getting to the, we're making the move where you start tilting the scales where it does become much, much better to do an electric vehicle versus an internal combustion engine. So we're getting there. Like, we're not there yet. We're still about reducing operating costs, meeting sustainability goals that are really important to major brands like Coca-Cola and Pepsi. But we're not yet in terms of that revolution, that mass adoption. That's not there yet. It could potentially happen in the years ahead with revolutionary products. You need to have the revolutionary products that bring down the total cost of ownership below internal combustion engines. What about the market potential just based on their current products? And it's enormous, where they're talking about the global total addressable market is over $1 trillion, over 1 million vehicles sold annually in North America. Fleets spend over $1 trillion in fuel per year. But once again, it's tricky to get that true revolution where you're tapping into this $1 trillion market until the total cost of ownership goes below the internal cost, the internal combustion engine. So that's worth thinking about when you're thinking about, like, what's the market potential. Could they grow very quickly? Yeah, they're growing very, very quickly this year. Could they keep it up in the years ahead? Quite possibly. We'll get to that in a sec. But does this answer the question of, do you have 10x potential? And I think it does. I think this smells like, yeah, you definitely have 10x potential, given that you're tapping into this huge marketplace and you have these very, very prestigious brands. That means they've tried out your product and they like it, and they're increasing their orders. Your largest order is 200, now it's 1,100. That's a big deal. What about their financials? Like, what are they guiding to? And so here it is, 2019, you see 7 million in revenue going to 21 million in 2020. So nearly 200% growth, nearly tripling. And they say that 95% of 2020 is booked. So, like, you got to give them a lot of credit for execution here. Like, this is a company where it's like, you're catching them in that stage where they are delivering. So that's super exciting to see. You can see that they're actually gross margin profitable in 2020, which is, still good to see. They still have a lot of margin improvement to do. Still dramatically unprofitable. You're looking at negative EBITDA of negative 50% margin. They're saying that can improve to profitability by 2022, and that you're going to continue to see this really fast, 100, 200% plus growth in the years ahead. So you're seeing rapid growth, low margins, years until profitability. Like that's what you're seeing. I don't see this business as getting dramatically better margins. At the end of the day, this is sort of a intermediary in getting a vehicle to end users. So you're never going to get crazy margins. This is sort of like a supplier in the auto chain. And so, penciling out 25% gross margin, maybe 15 to 20% operating margin, maybe. So you could sort of see what they're penciling out, like 22% EBITDA margin. We'll see about that, but you could see like 15 to 20 is possible. Like maybe 10 to 15 is more reasonable. Anywho, what's the possibility of this actually succeeding? I did a video on Hyliion where I sort of made this outrageous comment that, like, I think the odds of Hyliion's management of hitting their forecast, I think it's just as likely that I would beat LeBron James in a one-on-one game of basketball. I would not make that bet here. That said, it would still be super duper tough for XL Fleet to hit this. Like this is still like management's forecast is always going to be the rosiest scenario that you're going to get, because look, this is what you use to raise money and get an attractive valuation. So anyway, I'm less comfortable making outrageous bets like that, because I'm seeing this, this company that is delivering, 200% growth in 2020 is pretty interesting. And they're growing based on their existing technology, and that increases their probability, where they're showing like, yeah, we're using the technology, the hybrid technology, and that's the base of most of our growth over the next few years. And then plus they say like, we have a pipeline of 220 million potential sales in the next 12 months. So that's a big deal to be able to like say like, yeah, we're talking with customers for this. Now, pipeline's obviously a very squishy term where, who knows how it ends up shaking out. But, when they're saying, yeah, almost all of our growth is going to come from, our existing product lineup, I feel a lot more comfortable. Yes, the yellow and the green over here are new products that have yet to come out in the years ahead. But or it's based on international in the case of yellow. It gives me more confidence seeing that, that this orange tab is making up a good chunk, and that's what their existing product lineup. So can they actually scale this fast though? Can they continue to deliver 200%, let's say, growth in the years ahead? And this is where their strategy of partnering with the upfitters makes the most sense, because they don't have to build out a big factory to be able to install these. They're working with these partners that are already around, around North America, that already produce 100,000 commercial vehicles per year. So for them to get the scale they need actually wouldn't cost that much. And they call out that if they wanted to get to 10,000 units per year, it would cost them $500,000. That's incredible, just how little that is to get to 10,000 units a year. To get to 100,000 units a year, it would only cost them $5 million. That level of scale, this is incredible, especially when you're thinking they're going to have a couple $100 million on their balance sheet. They say the time frame to get to that is 6 to 18 months. So I really like this business model of working with effectively the existing chain of production to be able to say, hey, yeah, if we're getting the demand, we can scale that quickly by working with these partners. And you do create this potential win-win where you're paying these upfitters probably some sort of commission to say, hey, every time you do this, we're giving you this business. So they're excited to get that business and do that installation. So you have this potential win-win. You have a business model that can easily scale, which strikes me as interesting. But I should make a comment that before diving into, are they unrivaled, which is the key question I look at every company, because this is a key filter that gets rid of 95% of the investment universe. Because if you're unrivaled, it means you stand out from the competition. It means you have a good or service that others simply don't have. And when you have something that others don't have, it sort of gives you the right to win. And if you're tapping into this huge marketplace and you have something that no one else has, people are going to go to you and you're going to grow over time. And so I look for that unrivaled value proposition. Most of the time, most companies don't have it. It's rivaled. It's really tough. Companies are just perpetually fighting it out. You have price wars, you have margin wars. It becomes really challenging. And so I need to sort of caveat this, which is that my circle of competence for judging whether or not a company has an unrivaled value proposition really comes down to, looking at execution, how well a company has executed, and whether or not the thesis is clearly explained. Like if a company puts it on a silver platter, and occasionally you read enough companies and it's so crystal clear why a company is going to keep growing, what makes them stand out, and you read it and it just jumps off the page. It becomes obvious. Oh, this is why you're unrivaled. This is why you're going to keep growing year after year. I think you've probably seen enough videos where I even called out in one where hey, this is straight from the 10K that they're calling out that they're unrivaled. The 10K is the annual filing. And so, if it's clearly explained, I can size up an unrivaled value proposition and I can judge execution where you're growing faster than your competitors. That's what I can, that's in my circle of competence when I'm judging a company. If this is based on super scientific, oh, your battery technology is going to be better than these other players, that's really tough for me to underwrite. My last video, I did it on a space company, Momentous. I don't have the special insights on rocket science to say, hey, this product's definitively going to work. So I need to focus on my circle of competence, which is clearly explained thesis, and I need to rely on execution to believe it. Because if there's no meat to those bones yet, I can't really rely on it. So you need to understand that when I'm looking at any company, that's how I'm thinking about value proposition is, do you have the execution, and is it clearly explained in a way that I understand? So is XL Fleet unrivaled, or are they rivaled? And they actually make this fairly easy for you to see, where they're like, look, we're just crushing the competition. They are a leading contender, I would say, where they have, X number of units sold, 4,000 units sold in 2020, looking at another 9,000 in 2021. And they're just crushing everyone. And you can see the number of models announced and their customer base and how they're just crushing everyone that's trying to compete with them, whether or not it's Hyliion, Workhorse, Nikola, Lordstown. A lot of people have asked me to do these videos on these other ones. I think now that I've done XL Fleet and Hyliion, I think I'm good. But between the fact that they're looking to adapt to the industry as is versus completely reinvent an electric truck, they might have a lower cost and easier to scale business model that might just be unrivaled now. So based on execution, I could say thumbs up. You are beating the competition. You are growing faster. You're delivering and you've got major customers. So I would say, yes, you are definitely a leading contender now. But I don't know what the future holds. This is a picture of the Tesla Semi. I don't know. I don't know if you reach that point in the future, and I don't know when it could be, and I don't know if it's Tesla. But is it possible that someone sort of disrupts the industry in the future with a much lower cost of ownership, or just a cost of ownership that's pari with an internal combustion engine? And when that happens, if you have a completely electric vehicle made by someone else that's pari with an internal combustion engine, so a normal truck, then this hybrid is toast. So that's the challenge here, in my opinion. What are my thoughts about the valuation? And by the way, that truck just looks sexy. If they deliver that, that'll be incredible. So the hypothetical valuation framework, this is my value proposition to you, which is that you can play around with this yourself. If you go to the description of this video, there's a link below for you to click on. You play around with it yourself. The stock price can go way higher, way lower. I want you to play around with your own assumptions when you're thinking about, hey, this is what I think the stock could do potentially over the next 5 years. So you can see right now it's around $1.5 billion valuation. You can see they're growing very, very quickly. I'm effectively modeling out the scenario that management provided. And I'm using optimized margins of 15 to 20%, which is within range of what management provided. What's the growth rate? I pencil out slightly lower than what management says. That's partly due to my conservative, nature, where I see, hey, you're growing at 190% this year. Generally, it's harder to get acceleration to 190 to 250 like they're expecting. I generally see 190, and I think at best you stay at 190, 150, 140, and it comes down. That's my expectations. But hey, if they're able to post some accelerations, then fantastic. And that's what they are expecting, given that they have more products coming up. So I'm saying 50 to 100%. Look, you disagree with me? Feel free to change it. And you can see, that they are multiples of their size in 5 years from now. Like they're either 30 times larger or 8 times larger their size in 5 years from now. And, what sort of multiple do you want to assume in the years ahead? And this is, once again, you can have a super wide range. My view is that you're going to have increasing competition. You already see all these different players. So it's very possible you have a very lofty valuation because you have a company growing very quickly. It's also possible you have a much lower valuation. So I say 25 to 50 times, which is a pretty wide range for 5 years out. It's also possible you get way lower in the future. You get a wide range here. And so I'm saying maybe 70% downside, maybe 240% on the upside. And keep in mind, my upside case is still well below management's forecast, where, for example, management's forecasting 1.4 billion in sales by 2024. Here it is. I'm saying 2025, they're at 700 million. So like half of what they're expecting by 2024. So if management is right, the upside truly is huge relative to what I'm penciling out here, which is the upside of 240%. That said, I prefer bets where I'm more confident in the long-term value proposition. I don't see potential risks on the horizon that completely disrupts the current balance of competitors. I also, like it where it's super clear, like, hey, this is your unrivaled value proposition, and I'm getting it. Maybe I'm starting to buy it at a price where my downside is somewhat protected. I don't like buying things where I'm like, yeah, I think this can decline easily 70% in the next 5 years. If they only grow at 50% a year, 50% a year, like most companies would love that. Obviously, like they're saying that wouldn't be good enough. So anywho, I prefer situations where, hey, heads, I don't lose much. Tails, I still make a couple of 100%. But to see those types of bets, you do need to go to unrivaledinvesting.com to see what I personally own, what I am personally looking to buy and sell, what I hold each month. You can't take these shares away from me. There's exclusive content just for Journey subscribers, as well as, look, all it takes is one potential multi-bagger to change your life journey. So if you're interested in following my journey to try to find these multi-baggers, go to unrivaledinvesting.com, click on Journey. If you enjoyed this video on XL Fleet, please make sure you subscribe. If you're already a subscriber, hit that thumbs up. Thanks so much for watching.